And as slide 8 shows, our current booking pace points to a meaningful recovery in 2026, with volumes moving toward long-term regional norms. Two structural drivers support the trend. First, fleet age. Many operators deferred replacement over the last 2 years, and as 4- and 5-year-old fleets become more costly to maintain, quoting activity increases, driving both equipment sales and the recurring parts and service revenues that follow each unit. Second, product breadth. Our OEM partners are introducing modular, value-oriented configurations for lighter-duty applications, allowing us to serve cost-conscious customers with fit-for-purpose equipment while preserving our premium offering where uptime and life cycle support matter most. Our material handling share gains are being driven by 3 factors: stronger participation in the fast-growing warehousing segment, new products that allow us to recapture business previously lost to value-oriented brands, and PeakLogic's integration capabilities, which enable us to advise customers on and execute larger and more complex projects. Construction equipment entered the quarter with the delayed seasonal start, but activity accelerated through the quarter, carrying the segment past its first quarter low point. Market deliveries in our areas of responsibility increased 20.1% in the second quarter versus the prior year, and were up 7.5% for the first half. Florida was a notable area of strength, particularly in articulated haulers, and quoting activity is benefiting from road and bridge work, municipal projects, energy infrastructure, and manufacturing investment. The competitive environment is healthier than a year ago. Dealer inventories have declined, OEM discounting has moderated, and used equipment values have improved from their 2025 lows, all supporting better equipment margins. Our rental fleet initiatives continue to progress. The goal is matching fleet investment to local demand, improving utilization and returns, and avoiding underproductive assets. Tony will detail the results. Product support remains one of the most important differentiators in ALTA's dealership model, with 85 locations, approximately 1,100 factory-trained technicians, and more than 1,000 field service vehicles, creating reoccurring revenue streams that pure-play rental models do not replicate. Through our customer value mapping initiative, we are aligning capacity with customers who value uptime and lifecycle support while improving rate realization and service productivity. Our strategic vision for 2028 focuses on generating more value from the platform we have built. Since our IPO, we have completed 17 acquisitions and grown from 43 to 85 locations. The next phase centers on organic growth, operating consistency, and disciplined capital allocation, gaining share in attractive markets, scaling PeakLogix and Ecoverse, improving product support productivity, increasing inventory and fleet returns, and using technology to drive efficiency and accountability. As we enter the second half, demand indicators remain constructive, led by material handling bookings and backlog, construction equipment project activity, and healthier channel conditions. We are maintaining a measured outlook, and Tony will discuss our revised guidance. The second quarter does not complete the recovery, but it provides clear evidence that one is underway and that our operating model is responding as expected. I want to thank our approximately 2,600 employees for their commitment to our customers. Their expertise is the foundation of ALTA's value proposition. With that, I'll turn the call over to Tony.
Thanks, Ryan. Good evening, everyone, and thank you for your interest in ALTA Equipment Group and our second quarter 2026 financial results. Before getting into the quarter, I'd like to thank our employees, customers, OEM partners, and shareholders for their continued support. We entered 2026 facing a number of challenges, including the pull-forward buying activity that benefited late 2025, difficult winter conditions, and softer equipment markets. While Q1 was challenging, our second quarter performance and the trending KPIs suggest all of those headwinds are behind us, as the second quarter reflected a return to more normalized operating conditions and showcased the fundamental earnings power of our dealership model. My remarks today will focus on 3 areas. First, I'll report our second quarter financial performance and discuss the significant improvement we saw versus the first quarter, along with the key drivers behind our results. Second, I'll discuss capital efficiency, which remains an important priority as we continue to optimize inventory levels, rental fleet investment, and improve returns on capital. Lastly, I'll provide perspective on our outlook for the balance of the year and discuss the indicators that continue to give us confidence in our ability to deliver within our previously communicated guidance. As always, I'll be referencing slides from our earnings presentation throughout today's call. I encourage investors to review our earnings presentation as well as our 10-Q, both of which are available on our investor relations website at altg.com. With that, let me begin with our financial performance for the quarter, which corresponds with slides 12 through 22 of the earnings presentation. For the quarter, ALTA generated revenue of $475.5 million and adjusted EBITDA of $48.6 million. Nominal gross profit increased year over year, and total gross margins expanded approximately 70 basis points to 26.1%, while EBITDA margins increased to 10.2%. While revenue remained modestly below prior year levels, the more important takeaway is the sequential improvement versus Q1, and the results were encouraging. Revenue increased by approximately $65 million compared to the first quarter, while adjusted EBITDA increased by approximately $20.5 million from $28.1 million in Q1 to $48.6 million in Q2. EBITDA margins expanded 340 basis points sequentially. While some of that increase reflects normal seasonality as construction and rental activity improve entering the summer months, it also reflects strengthening equipment market conditions, improved equipment margins, and solid execution across our operating businesses. One area I'd specifically highlight is equipment margin performance. Company-wide new and used equipment gross margins increased to 15.3% during the quarter, representing a meaningful improvement both year over year and sequentially. We believe this is an important indicator of more balanced supply and demand dynamics across the competitive landscape. From a segment perspective, first, material handling, which we were particularly pleased with, generated $19 million of adjusted EBITDA in the quarter, an increase of approximately 13% from the prior year despite lower revenue. Strong service execution, sustained booking momentum, and improved operating efficiency all contributed to the segment's performance. Construction equipment generated $30.6 million of adjusted EBITDA, a notable $16.7 million sequential improvement. Equipment margins improved, utilization trends strengthened throughout the quarter, and the business benefited from the expected seasonal recovery following a slow start to the year. Within master distribution, Ecoverse delivered one of its strongest quarters since acquisition. Revenue increased from $20.9 million to $22.8 million year over year, while adjusted EBITDA increased from $1.1 million to $2.8 million. Importantly, much of the tariff-related margin pressure that negatively impacted the business over the last year has now subsided. Revised OEM pricing arrangements and a more stable tariff environment both contributed to materially improved profitability. As a result, Ecoverse returned to the economic profile that underpinned our original acquisition thesis. Taken together, these results support what we discussed last quarter, namely that many of the factors impacting first quarter performance were temporary in nature and that the underlying business remains fundamentally healthy. Moving on to the second portion of my prepared remarks, I'd like to spend a few moments discussing capital efficiency. One of the most encouraging developments during the quarter continues to be the progress we've made on improving capital efficiency across the organization. I direct investors to slide 16 of the earnings presentation, which highlights the tangible results of our inventory optimization and fleet rationalization initiatives. In material handling, average assets declined by approximately $52 million, or 11%, while the business maintained relatively consistent earnings performance. As a result, trailing 12-month adjusted EBITDA as a percentage of average assets improved 120 basis points from 14.8% to 16%. In the construction segment, average assets declined by approximately $77 million year over year, or 8%, while profitability remained resilient despite operating in a market that's still below historic levels. That resulted in a 60 basis point increase in return on assets from 10.8% to 11.4%. We believe this demonstrates that ALTA is becoming a more capital efficient organization, generating comparable earnings while deploying less capital and ultimately improving returns. Briefly, on the balance sheet for the quarter, as of June 30, total liquidity remains strong at approximately $225 million, and net leverage remains stable at roughly 4.7 times. Importantly, our capital structure continues to provide flexibility as we have no meaningful debt maturities until 2029, a largely fixed-rate debt profile, and ample liquidity to support the business going forward. Moving on to the final portion of my prepared remarks, I'd like to discuss our outlook for the remainder of 2026. We continue to believe that the assumptions underlying our previously communicated guidance remain intact. As shown on slide 19, we are narrowing our adjusted EBITDA guidance range from $167.5 million to $177.5 million, reducing the upper end of the range by $5 million, while reaffirming our free cash flow before rent-to-sell decisioning range of $100 to $110 million for the year. Importantly, the adjustment to the upper bound is not being driven by a change in our view of underlying demand, as bookings trends remain supportive and backlog levels have materially increased year over year. Rather, the revised range reflects increased visibility into the timing of equipment deliveries and the conversion of the backlog into revenue during the second half of the year. Overall, there are several pillars supporting our confidence in the back half of 26 when compared to 25. First, material handling fundamentals continuing to improve. As Ryan mentioned, backlog has increased substantially year over year, providing for improved confidence into second half equipment deliveries. Second, construction equipment demand is growing across our core markets. Customer activity remains healthy, and infrastructure-related project activity continues to support equipment utilization and demand. Third, equipment margins continue to trend favorably. The margin improvements we've discussed today are consistent with reduced competitive discounting, healthier used equipment market dynamics, and more balanced dealer inventories. Fourth, eco versus tariff-related challenges appear to be behind us. The business returned to a more normalized profitability level during the quarter, and we believe those improvements are sustainable moving forward. Lastly, the organization continues to execute on productivity and operational efficiency initiatives across multiple departments. Our product support organizations remain focused on tech utilization, labor efficiency, pricing discipline, and customer profitability. While these initiatives may not always maximize revenue growth, they do improve overall dealership profitability and support stronger long-term returns. Taken together, supportive demand indicators, growing backlog, improving equipment margins, and continued operating discipline support our confidence in the business in the second half of 2026. In closing, the second quarter represented a step forward. The business benefited from both the expected seasonal ramp and improving conditions across our end markets. Perhaps most importantly, we demonstrated that ALTA can generate stable or improving profitability metrics on a significantly smaller asset base, which will translate into better returns on capital over the long run. Thank you for your time and continued interest in ALTA Equipment Group. I'll now turn the call back over to the operator, and we'll be happy to take your questions.
We will now begin the question and answer session. If you would like to ask a question, please press *1 to raise your hand. To withdraw your question, press *1 again. We ask that you pick up your handset when asking a question to allow for optimum sound quality. If you are muted locally, please remember to unmute your device. Please stand by while we compile the Q&A roster. Your first question comes from the line of Mike Shlisky with D.A. Davidson. Your line is now open. Please go ahead.
Yes, hi. Good afternoon. Thanks for taking my questions here. I wanted to circle back to some comments you made earlier. Hi there. Yeah, I want to go back to the comments you made earlier about some of the material handling modular products. I really appreciate it that this is a growing area, but is there an offsetting service revenue headwind when you sell more modular compared to some of the original models?
Mike, I'll take that. No, we don't perceive it as a headwind. If anything, it's a positive because there'd be more commonality across the product lineup, and that would potentially enhance parts turns. Okay.
And then turning to construction, I do appreciate that Volvo increased their outlook. Other large OEMs may have increased their outlook a bit more than perhaps Volvo did. And I'd just be curious, in Florida and your main markets, where it's been strong all along, I think, do you feel like your share has been hanging in there in the first half, and anything that could be changing here in the second half as far as construction market share?
Hey, Mike, this is Tony. I'll take that one. I think we've got the one slide in the deck that shows what our markets did from a delivery perspective in Q2. relative to 2026 relative to 25. And I think those markets were up something like 7%. And so we definitely saw that. Now they were down a little bit in Q1. But long and the short of it is, the number that Ryan mentioned and what Volvo's focused on, I believe, is North America. The one that we're focused on, obviously, is the one just for our APRs. They seem to be in alignment with one another, maybe ours being up a little bit. In terms of share, I would just, we don't call out market share specifically publicly, but I would think of us as just holding share in the current marketplace and over the first half.
Okay. And then maybe just lastly on the on rental fleet sizing, again, with some of the upticks we're seeing in large projects, infrastructure, and other areas, are you thinking about potentially upsizing your fleet just a little bit to match that demand, or do you think what you've got now is pretty appropriate for the envelope of projects that your customers are facing?
Mike, this is Tony again. The way that we think about the rental fleet is laser focused on hitting our utilization KPIs. And at the moment, we're still not there. And so to the extent we see demand kind of staying where it is, specifically in the construction fleet, all of this commentary would be specific to our construction fleet. We intend to continue to pare it back a bit by year end. The other thing that I would point out to you is that some of the data centers and projects that you are referencing are more akin to vertical construction, which would mean aerial equipment, which the larger rental houses compete in, and we do not. It's a much smaller piece of our portfolio in terms of the rental business, and that's all there on slide 17. And so we're certainly participating from a land clearing perspective. We know of jobs that our customers are on where they need, dump trucks and excavators. But those projects are, a little bit shorter relative to, call it the vertical construction of the building. So the short answer is no, we don't see, investing in rental fleet in the short run here.
Okay. Fair enough. Thanks so much. I'll pass it along.
Your next question comes from the line of Stephen Ramsey with Thompson Research Group. Your line is now open. Please go ahead.
Hi, good evening, everyone. Wanted to start with the color you shared around the marketplace being more balanced from a supply-demand standpoint and leading to reduced discounting. Would you say that the market is in a healthy and optimal spot at this point, or it could keep trending in a healthier way potentially through the back half of the year?
Hey, Stephen, this is Tony. Before I answer your question, I just wanted to point out I misspoke on the question Mike had. Equipment deliveries in our construction markets were up 20%, as suggested on slide 7. I said 7%, which is the year-to-date number. Anyway, all signs point to more normal supply-demand dynamics, which what we have believed all along would help support more normal margins in terms of discounting that we have to do to kind of hold share, specifically in the construction segment. I think there's still a little bit more room to run. We have, as we've suggested, really tried to optimize inventories, and by doing so, we've actually had to take some skinnier deals to offload the balance sheet a little bit. So we think we still got some tailwinds in our own numbers, through the back half here from an equipment margin perspective. But I think from a macro environment, we've found that balance. What I'd say pricing wise, I think pricing still has a little bit of room to run as well. Some of the larger players in the construction space that you're well aware of, I think are showing price realization year over year of 5% in the second quarter in terms of, what the OEMs are charging their dealers. As their costs have gone up, tariffs have been impacted. it's been a while, but we're finally seeing, less discounting coming out of some of the bigger houses. So I would expect that to continue and prices to continue to improve just overall, but much more balanced than we've been, over the last 2 years.
Okay, that's great to hear. And then one thing I wanted to clarify in the guidance, the part of caution around deliveries. Can you talk a bit more about where that caution or conservatism is coming from, if it's a certain product set or certain customer group?
No, so it would simply be on the, some of this is as Ryan mentioned, the material handling backlog is getting to like record levels from a nominal dollar basis. We're still not there from a just a unit perspective. It's really just timing with Hyster-Yale, with their production capabilities and the ability to deliver, and whether or not some of the demand sneaks into 2027, Stephen, versus 2026. It's not a specific customer base. It's not really a product line per se, but it would be more on the material handling side, particularly Hyster-Yale. And it's not that we are saying that there is risk that we know of. We're just being mindful that, the level of volume coming through could leak into 2027.
Okay, that's helpful. Thank you.
Your next question comes from the line of Liam Burke with B. Riley Securities. Your line is now open. Please go ahead.
Thank you. Good evening, Ryan. Good evening, Tony.
Hey, Liam.
Tony, you were talking in your prepared comments about the reducing the higher end of the guidance, not basically because you have better visibility. I'm looking at the two major businesses. Materials handling with the order flow gives you a pretty good sense as to what the second half is, understanding that you talked about orders slipping into 2027. On the construction side, what are you seeing that gives you more visibility on the second half activity?
Yeah, I think it's just general momentum, Liam. As investors and some of the analysts are aware, the material handling purchaser and that cycle is about 6 months from when we get a booking, place an order with Hyster-Yale, all the way through our ability to invoice, just as a rule of thumb. And it could be less or it could be more. So we have great confidence that we're all going to perform. We will outperform the back half of 25 here in 26 because of that. And again, the timing issue is really what we're very bullish on demand. It's a timing issue that impacted the top end of the guide. On the construction side, as you mentioned, it's more momentum. Q2 deliveries were above Q2 26 were 20% above Q2 25 in our marketplace. And we still see a lot of quoting activity. DOT budgets are now in and are effectively holding pretty flat against what were peak levels seen in 2025. So there's lots of work to be done here in the back half. Our rental fleet and the construction side is out with no sign of, things are still going out on jobs versus coming back. And so all of those things give us confidence in the back half of the year on the construction side, as well as some cost takeout things that we were able to kind of execute toward the end of Q2 that we expect to see in the second half as well.
So that's just a follow-on the construction cost reduction. You had a step up in gross margins on new and used equipment sales. Do you expect that momentum to continue the second half as volumes improve?
In a word, we don't expect it to retreat, and we would probably expect a little bit more juice on gross margins in the second half.
Great. Thank you, Tony.
Thanks, Liam.
Your next question comes from the line of Steve Hansen with Raymond James. Your line is now open. Please go ahead.
Yeah, guys, thanks for the time. Appreciate it. I just wanted to ask one of the earlier questions a different way. It's just around the guidance. Any reason you didn't decide to take the lower end of the guidance up, perhaps just given all the optimistic commentary here in the outlook so far? Thanks.
Steve, I think it's just, building in a little bit of a level of conservatism maybe into the guide. And really, when we think of the back half, the EBITDA is heavily weighted to the back half, something like 90 or 100 million implied. And so what we were looking to do, one, is just squeeze the range for the investor community. And we felt like, understanding that there can be some variability in deliveries and so on, we would take the top end down. And we have great confidence, in the low end at the moment.
Okay, great. That's much appreciated. I just want to go back to your utilization or your asset optimization, comments earlier as well. And how do you feel about the working capital build necessary to sort of support some of this growing order momentum that you see out there? Do you need to build a lot of working cap in the next sort of back half here, or how do you feel about that?
No, if you think about it, Steve, most of these, the back half is going to be supported on equipment deliveries. All of that is typically floor planned at 100% loan to, payable to value, if you would, for floor plan payable to value. So there'll be a little bit of investment in AR, but that's a quick turnaround typically when you're selling equipment. So that's a long way of saying no. We wouldn't expect working capital investment in the back half. In fact, as we start to see projects wrap up, typically our cash flows are, especially in the fourth quarter, collections come in and we end up getting working capital release in the back half. And I'd expect to see the same this year.
Okay, appreciate it. And just one last one, if I may, is just around the support side. With the broader backdrop improving, as you described, any desire to start to reinvest in some of the product support team or pursue techs in a more aggressive fashion here? How do you feel about your support capabilities here moving into the new cycle?
What I would say, it's a tale of two segments, probably, Stephen. What we have been focused on over the last 12 to 18 months is technician retention, training, and then uptime or efficiency with technician heads versus adding technician heads. There are elements of the business where we need more techs, in material handling, given some of the inflection that we talk about, could be one of those areas in the Midwest specifically, where manufacturing and some of the automotive stuff is starting to ramp back up. And we've been in the Midwest for 40 or 50 years now, and we've got all kinds of different ways to recruit and attract talent. So that would be a place where we're more bullish on and then on the construction side, it's more about getting labor utilization up. There are elements of the business, areas of the business where we would be looking to take on more heads. New England and the Northeast comes to mind. So it's spotty. Right now, we always want to look for highly technical individuals. We're always kind of recruiting, but we don't have any major plans at the moment to we don't need 100 mechanics or anything like that at the moment.
Okay, much appreciated. Thanks.
Your next question comes from the line of Ted Jackson with Northland Securities. Your line is now open. Please go ahead.
Thanks very much for the time, and looking forward to the second half, guys. My first question on material handling, if you listen to the Hyster-Yale call yesterday, in one regard, they actually kind of trimmed their second half 26 delivery outlook, not because of a demand issue. Clearly, the bookings are very, very strong, but there was a change in the 232 tariffs that, in response to that, they chose to delay some deliveries so they could shift their manufacturing from, say, Europe to the U.S. to avoid those tariffs, and did that obviously in conjunction with their customer base. And when that happened, did that have any impact on your look for the second half, and maybe gave you a view that some of that what am I trying to say? That maybe the second half, some of the stuff that you thought you were going to be able to put revenue on the table in material handling maybe got pushed a little out, and some of it's going to come in 27. And again, it's not a bookings issue. It's just it's a smart move on their part, because they're saving 15 to 20% that they would have had to pay if they hadn't made this change. But do you understand what I'm asking? Did you see the impact from that?
Ted, there wasn't anything that, in general, what I would say is the movement, in what we were discussing about the guidance in the back half for material handling is generally correlated to just, general execution risk in terms of the cadence of bookings, producing from Hyster-Yale perspective, all the way through kind of end market, our shops, prep and delivery, and then invoicing. So it's just general execution risk that we were thinking about. I'm not familiar specifically with what the tariff issue was and the repatriating of the manufacturing, so that was not a specific element, and I don't think that would impact us one way or the other in terms of just the general execution risk that we always have when we start to see backlog jump like this.
Okay, no, it was just it was something more of an interest to me. You made some commentary on utilization rates and the rental fleet, and obviously that's an admirable goal to obviously you drive them up, use them more, you make more money off them. Is there a target that you would share in terms of where you want it to kind of settle in at? I think right now when I looked at it and did my calcs, somewhere around the mid-30s was with the last quarter. When we look at that business, say, a year from now, or whatever time frame you kind of think of, where do you want to get it?
So Ted, the way that we think about it is if I do the math here, TTM rental revenue. Give me a minute. TTM rental revenue is 175. At the moment, we're at the end of Q2, we're carrying $500 million of gross fleet. We would like, so that's 35%. We would like that to get into the high 30s, or even touch 40, if we could get that metric there. So it goes to what Mike was asking. We still are not where we want to be on our metrics, and now we're improving, and we've made a lot of progress, as I mentioned on the prepared remarks. But if you wanted a kind of a benchmark, that's where we would want to be.
Okay. Third question. We don't talk too much about Ecoverse, maybe I don't or think about it that much, but you had a good quarter out of it. You do have I'd view kind of Terex and part of their business as a comp for that. They, had also seen some challenges within that world, and in their quarterly call did express some pretty solid optimism with regards to the business, as they kind of thought through, and I think they were really talking more about 27. They just felt like the business itself was really on the turn and on the mend. Can you provide us a little update on kind of what you're seeing within that market, and do you agree with that, and what the drivers are?
Ted, from what I understand about Terex, is they're more into crushing and screening. They may have an environmental line or two, but we don't. They wouldn't be competitive to some of the things that Ecoverse is doing, which is more of the environmental processing equipment. And we've always seen tailwinds here in North America for this type of product. There was just, given that we're an importer, and just to remind everybody, we are the direct importer from Germany primarily and Europe for a lot of this specialty equipment. And there was just so much turmoil, I would say, over the last year, and we've had to renegotiate pricing, reset pricing with customers. So, we believe the demand was always there. It was a margin issue and just a cost issue that we had to work through, which, as I mentioned, we feel like is behind us. But that's to say we always have felt good about the demand. We continue to feel good about demand for those products. now we finally have our cost in line with kind of the revenue that we're able to get in the marketplace to earn an appropriate margin.
Okay. And then my last question is around PeakLogix. You've got a product line now coming out of Hyster-Yale that's far more competitive, in terms of honestly getting into the warehouse market. You have a warehouse automation solution. Is there a benefit to you for, having both of those together? Like, is the better and more competitive product offering from Hyster-Yale help you sell PeakLogix? Does PeakLogix help you sell those, better designed, better, targeted, lift trucks from Hyster-Yale into the market as well? What kind of, synergies are there between those for you in a sales perspective?
This is Ryan. From the sales perspective, the leading part of the business, it's symbiotic. The same customers that are looking at trying to, put more through their warehouse, that are using narrow aisle equipment, are the same ones that would be leveraging the expertise of our PeakLogix team. So the analogy we use is if we sell the vehicle, now we can design and sell the track that the vehicle runs on.
And the fact that now you have a better product and can sell more vehicles and get, be more competitive will help you sell more track. Is that a fair way to think about it?
Yeah, and there are two product evolutions going on at Hyster-Yale. One is that they're making more competitive product for the warehousing segment, which is fast growing and is more of a specialized piece of equipment where we haven't been as strong historically. And then the other is that they're providing multiple price points of their legacy product, the more traditional rider forklift, so that we can compete on the high end of the market where we've always been successful, but also in the value part of the market. So that I wouldn't characterize our warehouse product as low cost. It's full featured product. It's a separate issue of them trying to drive a lower cost product offering for class 1 and 4.
Okay. All right. Well, thanks for taking my questions.
Thanks, Ted.
There are no further questions at this time. This concludes today's call. Thank you for attending. You may now disconnect.